Hey there, everyone. We're just waiting for a few more people to get started here. Okay, and we should be good. Well, welcome everyone. Thank you for joining us. This is the second edition of our webinar series, one we hope to continue into the future. Today, we're going to be covering the third quarter market update. And the plan is to keep it right around 30 minutes. So I will say in advance, if you don't have time to watch the whole thing, just let us know, reach out. If you would like a copy of the slide deck, please let us know. Also, we will be recording this and putting it on YouTube for those that would like that link as well. So let's get started. So the plan today is to go over a few different things. First, we'll start with a market update. We'll look at different asset classes, segments of the market, see how they did throughout the quarter. Then we'll transition into a portfolio review. We're going to talk about some of the changes we've made recently and the implication of those changes. And then we'll turn to the economy and then everyone's favorite topic, the election. Obviously, it's coming up very soon, less than a month now. So we're going to look at some things that could turn out from that. And then we'll wrap up by going over our fourth quarter market expectations and seeing, how we finish the year and what we can look for at the beginning of 2025. So let's get started with the market update. The third quarter was a really strong quarter for both foreign and domestic markets, right? Global markets in general just appreciated throughout the entire quarter. Something a lot of people may have not seen at the beginning of the quarter or forecasted, simply because, as a lot of you know, September historically is the worst month on record for the market. However, this was not the case during this September. We actually finished at all-time highs for the Dow Jones, the S&P 500, and then the tech-heavy NASDAQ. So very positive to see in terms of, where we finished the last 3 months. Another metric that we like to look at is called investor sentiment. And this is one of those more subjective, hard to measure sometimes indicators, but investor sentiment, right? The positivity, the psychology of the market did increase. Just from talking to clients alone, we could, sometimes hear a more cheery voice, even with the market going up so much. So it was really nice to see. Also, you look at other more, important indicators like flow of funds, right? People who are going from cash on the sidelines being invested into the market, that increased as well. And so while this is a sentiment that people, do look at, I will say, take it with a grain of salt because things can change very quickly in the market. And so while optimism is high right now, we obviously haven't had a lot of corrections or volatility in recent months, but that could always, happen. So just be on the lookout for that. But as of right now, I think there's a lot of optimism in the market looking at a couple of those factors. One of the factors being economic growth. I think something that, maybe had shocked people at the beginning of the year, if you were to tell them that, hey, we're going to have continued economic growth, GDP will remain positive throughout all of 2024, as it's looking like it will. A lot of people wouldn't have believed you, given, the inflation issues we had, the labor market weakness we had at the beginning of the year. But as of right now, GDP growth has remained positive. And then finally, really the marquee event for the third quarter was the Fed finally lowering interest rates. It was the first time in 4 years the Fed has done so, and they decided to lower them by 50 basis points, so half of 1%. Kind of a surprise to some market participants who were expecting a 25% basis point reduction, but the Fed did decide to lower by 50 basis points. And as we've talked about before, right, you always want to invest with the Fed and listen to what they're going to do. Chairman Jerome Powell has made it very clear that he intends to continue lowering interest rates. He said that he's been a man of his word, right? He does what he says and he says what he does. So there's no reason to expect that interest rates won't come down further from this level. But again, kind of the big thing that pushed equities higher in the third quarter was the Fed finally deciding to lower interest rates. So if we look at just broad-based U.S. stocks and seeing their performance throughout the third quarter, broken down by style, right? So you have two different style segments that we look at. We have growth-based companies Younger companies, more early on in their company cycle, they're gonna, take their revenue and net income at the end of the year and plow it back into the company to continue to grow. That's why we call them growth stocks. A lot of technology companies fall into these categories. You could think like Apple, Nvidia, Amazon, Google, things like that. And then on the other end of the spectrum, you have value-based companies, older companies in their life cycles. They tend to take their revenue and net income at the end of the year and pay them out in the form of dividends to shareholders rather than plowing them back into their company. For that reason, they trade at higher cheaper valuations in terms of like price to earnings and lower valuations in terms of price to book valuations as well, hence the term value-based companies. And then if we break them down by size, mega cap representing companies over 100 billion in value, mid cap representing companies up to or less than 20 billion, and small cap under 5 billion. You can see that in the third quarter, there was a very big divergence between growth and value-based companies. While growth-based companies over the first 2 quarters of the year outperformed slightly value-based companies, and even more so in the second quarter, what we saw during the third quarter was a rotation out of growth-based companies into value-based companies. And so one of the reasons to explain this could simply be investors taking profits off of the table that they've earned from having growth exposure over the first half of the year, repositioning it into value-based companies. If you go watch our webinar on the second quarter, we had talked about this potential rotation happening given the run up we'd seen in growth companies, and so to see it actually come true is interesting, right? Value-based companies, as you can see, did really well in the third quarter. Mega cap up 9%, large cap up 9.7%, even more so on this mid cap value play, and then small cap as well. But again, just looking at broad-based market returns over the last over the year, you can see that it's been a really strong year so far. I mean, we're above annualized historical returns. So again, very positive for equity markets. And oh, sorry, I'm getting a text from Alicia. I need to shift my chair to the right. Okay. Thanks, Alicia. So again, equities had a really strong third quarter and a really strong year-to-date quarter as well. So we hope to continue that going forward. Looking at foreign stocks, the foreign stock market, global markets improved throughout the quarter. They actually beat out a lot of US-based companies. As you can see, US actually slightly underperformed other different segments of the global market. This was due to the global economic recovery that we saw throughout the third quarter. You had a lot of different foreign banks lowering interest rates actually before the Fed, which has spurred equities to appreciate in those categories. Again, though, if you look at like the 3-year number, the US is still dominating in terms of performance. However, this is something that could change in the future, right? We always talk about asset classes reverting to their mean, and the US has been very dominant over the last 3 years. And so it's something that we could definitely see in the future, foreign international equities doing slightly better than US-based companies. But above all, the global stock market all essentially appreciated throughout the third quarter, which is good to see. Let me make sure, Alicia, if you can see this, let me know if I'm still good in the picture. Perfect. So fixed income, as you can see here, fixed income had a really good quarter. It was actually the best performing quarter over the last 5 years. And so, right, it's been tough for bond investors recently with interest rates rising. And we talk about this all the time, right? Interest rates and bonds go hand in hand, and they work conversely. So when interest rates are going up, the price and return of bonds is going down. As we've seen over the last 3 years with interest rates rising, it's hurt the bond market. However, with the Fed lowering interest rates and with market yields starting to fall, we've started to see a overperformance of fixed income assets. And also, right, interest rates and bonds are kind of that underlying effect on one another. They, work as that seesaw. But longer-term maturity bonds will be more sensitive to interest rate movements than mid and short-term bonds. So In the third quarter, as you can see, long-term bonds outperformed mid and short term because interest rates were coming down. However, over the last 3 years, long-term bonds have been underperforming their other two maturity categories because interest rates have been going up. So overall, very positive results from the bond market. Bonds obviously are an important part of the portfolio because they add diversification to the mix. They increase expected return and reduce risk. But it is nice to finally start to see that price return component coming back to bonds as well. So going into a portfolio review, with our stock, our equity allocation, we talked about this again at the second quarter update, but we had been overweight value-based companies for the first half of the year. And during that time period, right, the value-oriented stance, especially in the third quarter, did improve our portfolio return. It added to that return as well. International equities actually added to the portfolio and increased the return on that too, right? Foreign markets have stabilized and people are becoming more optimistic, and as such, foreign equities appreciated, adding to portfolio return. On the fixed income side, again, we saw the bond market recover throughout the quarter, and we have maintained our overweight stance in long-term maturity bonds. Again, we're doing this in anticipation of the Fed continuing to lower interest rates. We know when interest rates are coming down, the price and return of bonds is getting pushed up. And conversely, right, the longer term maturity a bond has, the more sensitive it's going to be to interest rate movements. So when interest rates are coming down, you want to have an overweight position in long-term bonds. When interest rates are going up, you want to have an overweight position in short-term bonds. And that's why we're overweight long-term bonds at the moment. So there are some changes that we've made in the portfolio as of the beginning of this week. First off, we just did normal rebalancing, right? Asset classes had gotten a little out of tolerance, so we did rebalancing back to target asset allocation. And if you remember, if you're in like a 70-30 or a 50-50 allocation, 50% bonds, 50% stocks, what you tend to see is, right, those asset classes will move. And so if the stock market has a really good quarter, maybe that 50-50 allocation is 55% equity and 45% bonds. So we rebalance back to that target asset allocation to get you in the correct mix that your risk tolerance is designed for, your time horizon is designed for. So it's really important that client portfolios always stay in those target asset allocation ranges. However, what we've also done in some recent changes this week, which a lot of you have seen in the portfolios as well, is we've decided to shift away from our overweight value position back to a neutral, more balanced position in our equity allocation. So we're no longer overweight value. On top of that, what we've also done is we've increased our allocation to foreign-based equities. Given the strength of the global economy, the strength of foreign economies, it was logical. We had been underweight international equities quite drastically for some time. So we're getting back to a more historical weighting in our portfolio for international-based equities. And then finally, on our bond allocation, again, we're continuing to maintain that overweight long-term maturity stance, given interest rates are expected to come down. So looking at portfolio design, so as you can see here, this is with US-based equity allocation, so that stock component of the portfolio. And before Monday, as you can see, we had a slight overweight in value-based companies, about 38% in large cap value compared to 30% in large cap growth. It worked out, right? Over the last 3 months, value-based companies have outperformed growth. However, again, as investors rotate and market participants change, what they want to be in at any given time, there are areas that you can always improve in a portfolio. And so we decided to return to a more balanced, what we would call a market-weighted equity allocation. And we call it a market-weighted equity allocation because if you were to look at every single publicly traded company in the US and classify them as either value or growth, there's slightly more growth-based companies out there than there are value. And so that's why you're seeing a slight overweight in growth compared to value. But again, that's just how the market is set up at this time. So we're essentially neutral in terms of our positioning between growth and value. Another reason we wanted to get back to this more market-weighted allocation is because it's just simply hard to ignore the tailwinds growth has had over the last year. You look at data storage, cloud computing, AI advancements. I mean, Elon Musk's robo-taxi announcement that came out earlier this week. When you're experiencing rapid technology shifts, like I believe we are right now, you want to be in turn positioned to benefit from that, and this change will help us do that a little more than where we currently were. And again, having both style regimes at more of an even stance allows us to participate in different aspects and in a more broad-based market should it continue to appreciate. So then transitioning to our international equity allocation, what we have here is an example of an ETF portfolio partners 60-40 portfolio mix, 40% in bonds, 60% in stocks. And we're going to just focus on this 60% in stocks. As a lot of you know, you can break down the 60% in stocks into different types. One of those types being US equities and foreign equities. And so before Monday, we had about 92% of our stock allocation in the US market, with only 8% in foreign equities. After the change and the rebalance, we've essentially reduced our equity allocation to US markets by 4% and increased our foreign equity allocation by 4%. Again, we did this because foreign markets have continued to recover. The US dollar has weakened, making exports, right? Companies are receiving more money for exporting their goods to the United States, thus helping foreign companies in terms of their revenue generation. And then also it increases portfolio diversification. And while I will say we are still naturally underweight international equities in terms of if you're to just pull an average American with a Charles Schwab account or a Vanguard account, they're going to hold roughly 20% in foreign equity. So we're still underweight in that aspect. But looking historically at our portfolios, this is about in line with where we usually have our foreign-based equity allocation. So shifting over to the economy here, and I wanted to talk about the Federal Reserve before we kind of dig into some key economic numbers. And a lot of people, a lot of people think the Fed is part of the U.S. government. However, it's not, right? The Fed is not part of the U.S. government. The Fed's a central bank. And what a central bank does is it regulates all other of its member banks out there in the United States. It provides financial services and regulates different aspects of the banking system. And then it also acts as a lender of last resort to other banks and to the government. So while it's not part of the government, it does have ties to the government, obviously. The number one tie is something called the dual mandate. And so the dual mandate is set forth by Congress. And that's why, Fed Chair Jerome Powell goes quarterly and speaks with Congress. And the dual mandate essentially is two jobs the Fed must do at all times. And so the first job here is called price stability. That's job number one. And we measure price stability through the inflation rate, right? The stability of prices. And so what the dual mandate states is that Congress says, all right, we need the Fed to keep inflation any given year at a target of around 2.5%. So we've experienced this recently, right? What happens when inflation gets above 2.5%? Well, the Fed comes in and they raise interest rates. And why do they raise interest rates? Well, it's because it'll slow down the economy. It slows down companies, right? You're increasing interest rates. You're making the cost of money more expensive. That's all interest rates are. And as such, companies slow down, right? They're not expanding. They're not getting business loans. People aren't going out and just spending money, right? Maybe it's more enticing to save in a high yield savings account at a certain interest rate level than go out and spend that money. And that's how inflation starts to slow down, as we've seen. So the Fed raises interest rates to stop inflation, but as an unintended side effect, unemployment tends to increase. Companies aren't expanding and they don't need as many employees. So you start to see layoffs and that unemployment rate continues to rise. Now, what's interesting is job number two of the Fed and the dual mandate states that the Fed has to always maintain full employment. And we measure full employment through the unemployment rate. And again, part of the dual mandate says the Fed needs to target unemployment of around 4% in any given year. So if unemployment rises above 4%, what does the Fed do? Well, they have to lower interest rates and spur economic growth. They have to spur companies investing their funds, right? Money becomes cheaper, money becomes more accessible. Companies go out and they hire more people to grow, and that decreases unemployment. The issue with that, usually, again, is that inflation increases, right? Because if more people have jobs and money is cheaper, people tend to go out and spend that money. Also, when interest rates are coming down, you tend to see equity prices rising. And so people get this wealth effect and they want to go out and spend. And that usually will push prices up, causing inflation. So the question is, can both of these issues be solved at the same time, right? They seem so counterintuitive. And so that brings us to something economists like to call a Goldilocks economy. And it's been tossed out a lot recently. And if you haven't heard it yet, you probably will soon. And it gets its name from Goldilocks, right? The old children's fable where right Goldilocks goes into the house with the three bears and she gets the first porridge that she wants to eat and she spits it out because it's too hot. And then she goes and tries the second bowl of porridge and she doesn't like that one either because it's too cold. But then she finds the porridge that's just right. And so that's the idea of a Goldilocks economy. It's that the economy is very well balanced. It's very healthy, and everything is kind of just right. And so I want to, look at that idea and see, well, are we actually in a Goldilocks economy, or are we being too optimistic? So let's take a look. And what I have here are some key economic figures for the last 4 years, so 2024 through September. Number one, inflation. Inflation's been an issue. Inflation in 2021 was 7.57%. Looking at 2024, now we have inflation of 2.4%. So inflation has come down drastically. How do we decrease inflation, right? Job number one of the Fed, of that dual mandate, those two jobs that Congress requires the Fed to do, is price stability, and they have to raise interest rates to do that, and they've done just that, as we all know, right? Interest rates in 2021 close to 0%. If we look now, where interest rates are at 4.83%, this is previously where they were for the last 4 years until we lowered by 50 basis points. But again, interest rates have gone up. It's reduced inflation. Unintended side effect usually is unemployment increases. However, unemployment has surprisingly not increased. If you look at 2021 unemployment to today, it's actually fallen to kind of that target range, that 4% range of that dual mandate. And even more interesting is the fact that we've had positive economic growth for the last 4 years, given all of this is going on. And so are we in a Goldilocks economy? Well, it's hard to see with just these economic numbers, right? Because we're always looking backwards when we look at economic data because you have to have something happen before you can measure it. You have to look at unemployment in the past in order to gauge it. So we turn to the stock market in order to, kind of figure out what's going on because the stock market is always forward looking. The economy is backwards looking. And so the stock market's trying to value itself into the future and see, based on future economic numbers, where are we going to be? And so, given the run up we've had in the stock market over the last 12 months, I think the stock market is confirming the fact that, yeah, the economy's in a really good spot right now. It's very healthy. The Fed has essentially done its job in terms of, entering that restrictive policy and raising rates, but not too much to cause a recession. And so it's very encouraging to see. Obviously, with any economic data, you can get surprises and events that change. But as of right now, the economy, in my opinion, is in a very good place. So turning to the election, it's going to be a very contested election. Emotions have been running high for quite some time now, and I wanted to just take a look at, kind of where we're at. So what I have here first is the betting market odds from earlier this week. I think betting markets are becoming more and more reliable gauges in terms of, trying to identify trends. They're becoming, not just sports betting. It's becoming more, you can speculate on anything out there, including elections. And anytime you have an area where people are risking capital, it's going to enter a lot of smart people and a lot of analysis. And so looking at the odds right now, as you can see, Trump has a slight lead over VP Harris in terms of winning the White House for the betting market. However, if we look at the polling data, and this is just an aggregate of all the polling, all the polls out there, and from the same time period, October 9th, you can see that VP Harris has a slight lead over former President Trump. And so what I wanted to show here is that it's essentially a coin flip right now. It's a toss-up, truly. And so I wanted to look at what we could expect to see from each candidate if they win. So regarding wealth, number one, the focal point of 2025, the first year of the winner's administration is going to be the Tax Cuts and Jobs Act that was enacted in 2017. This was obviously enacted during Trump's administration. So if Trump wins, you would expect him to want to extend this act. The act essentially cut corporate taxes from 39% to a flat 21%. It also raised the standard deduction for individuals doing their taxes. If VP Harris wins, as expected, she would most likely want this 2017 Tax Act to expire, right? She wants to put her own tax stamp on the economy. She's given indications that she wants to increase corporate taxes to around 28% and also raise capital gains tax. And I will say, right, the tax landscape is consistently changing. If you have any questions on it, ask a CPA what the tax law is like over the last 30 years. I'm sure they're going to be pulling out their hair. So it's very normal for taxes to always be changing. It's just interesting to see kind of where each candidate stands on them. In terms of employment, right? Another big gauge that people look at if Trump wins, right? Trump has said he wants to levy tariffs on foreign markets. You would expect that to increase U.S.-based jobs. And then with any Republican, historically, they're going to favor private sector growth rather than public sector, rather than government jobs. With Harris, as you can expect, it's the exact opposite, but still a way to add jobs, right? She wants to add jobs through infrastructure spending, which works, right? If you spend money to increase bridges and roads and things like that, that takes workers and that increases employment. And as with most Democrats, she's going to favor government expansion and increasing the public sector of employment. And then the stock market. So we get asked this all the time, especially over the last couple of years, what's going to happen with the stock market? So I wanted to just look at some interesting numbers. So since 1928, there have been 23 presidential elections. The S&P has ended the year positive 19 of those 23 years. So that's an 83% hit rate. And given the fact that we're so elevated in the stock market right now, I think it's safe to assume we end the year up positive. So that'd be 20 out of 24 elections. Even more interesting, right? If there's a Democrat in office and a new Democrat was elected, as would be the case if VP Harris wins, the stock market on average returns 11% that year. If a Democrat's in office and a Republican wins, the stock market returns slightly higher, 12.9%. I'd expect these to be the exact same if there was a Republican in office and a Republican wins to be 11% and a Republican and then a Democrat to be 12.9 because the market sometimes likes change. It likes to value itself based on what could be rather than what already is. So again, not very statistically different in terms of returns and performance. But the main feature here is the fact that the S&P has averaged 11.28% during all presidential election years. So that's why we tell people that the presidential election doesn't matter for your portfolio. It doesn't matter because if you look at history and you look at statistics, statistically, it's a good year for the market during presidential election years. And then also, right, the winner of this next election will either be in office for 4 years or 8 years. And I can almost promise your time horizon, right, is going to be longer than 8 years. So don't let these short-term events affect your financial goals. Don't let it affect your strategy. Stick with history, follow statistics, let statistics be your guide, and you'll be better off for it, right? You have to remove emotions as an investor when you're managing your portfolio. So finally, to wrap things up, where do we see the fourth quarter ending? Well, number one, the market always favors less uncertainty. And so in November, when we figure out who the president's going to be, that should benefit equities, right? Because the market's always trying to value itself into the future. And the more unknowns it's working with at any given time, the harder it's going to be at trying to find out that value. So after the election, we'll finally have an idea as to who's going to be the president for the next 4 years. Regardless of the winner, that uncertainty will become solved, and that should favor equities going forward. Number two, if the Fed continues lowering interest rates, bond markets, foreign equity markets, domestic stock markets, those should all benefit as well. And then we see the bull market continuing in 2025. Some interesting stats on bull markets. This one just recently turned 2. It started in October of 2022. And on average, bull markets last 5.5 years. The cumulative average return on a bull market is 181%. We're at over these last 2 years around 33%. So it'll be interesting to see, where we go from here. Historically, the strongest bull markets also tend to be during times of healthy economies, lower interest rates, technological advances, all of which I believe we're also experiencing at the same time. So there's no reason right now to believe we don't see a continuation of the bull market in 2025. So just to quickly summarize, domestic and foreign stock markets, bond markets, all appreciated throughout the third quarter. Again, we rebalance our equity allocation to a more even stance between growth and value. We slightly did increase our foreign stock exposure back to kind of our historical allocation. The U.S. economy has continued to improve. That idea of a Goldilocks economy or a soft landing seems more and more in touch. The U.S. election, obviously going to be very close. Don't let it decide your emotions. Don't let it decide your financial, goals or strategy, right? Stick with long-term statistics. And then finally, less uncertainty does benefit stock prices. So again, that bull market we see continuing in 2025. So I want to thank you all for your time. Again, let me know if you have any questions or if you would like to receive this in the form of a PDF slide deck or a YouTube link. And then finally, I will say we are hosting our 2025 Market Outlook event at the DoubleTree Hotel at 10 a.m. November 9th. So if you still want to come to that and you have not RSVP'd, feel free to reach out. You can give us a call or shoot us an email, and we're happy to get you signed up. So I was going to end this with saying go Royals, but unfortunately, since we lost last night, I'll end this with saying go Chiefs. Everyone have a great weekend. Stay safe. Thank you again.